Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
So welcome back to Sparta Market Outlook, your weekly snapshot of what's really driving the global oil markets. So this week we've got a full house and some jet lag to match. So June and Hua are joining us from Asia, where they have somehow found some time between client meetings and typhoon warnings to jump on the pod. Hi June, hi Hua.
Hi.
Brilliant. And Neil is back from holiday, tanned, relaxed and furious to find DFLs have collapsed while he was off grid. So welcome back, Neil.
Welcome back. Not feeling so relaxed anymore, as usual.
Brilliant. Okay, so it's been one of those weeks where everything feels oddly calm, and yet under the surface, there's plenty stirring. So from Ukraine to India to the Fed, meaning, as it seems to have been the case all year, so plenty of headline risk. I'm your host, Rachel Williams. We'll keep things as punchy as ever, and yes, we'll get the geopolitics out the way first. Then we're going to dive into some interesting ARB signals in the North Sea, a step change in East-West Distillate, and whether the 0.5 fuel oil story is about to flip. So Neil's going to start us off today, as usual. And let's be honest, after a week off, he owes us a solid headline run-through. Over to you, Neil.
Thanks for that. No pressure, I guess. Well, there's plenty of headlines. So in a way, I was a bit almost disappointed with yesterday. The main one in my mind being the deadline passing for the 25% additional tariff to be enacted on Indian trade to the US.
Yeah.
And I was disappointed in a way that I thought there would be more action, but actually, the Indians ended up being very defiant about it. And it just seems like Modi has stoked the spirit of nationalism to kind of get over this hurdle. And the long and the short of it is that it feels like even though the Indians have trimmed some euros purchases on the order of 3 to 500 kbd, they're not going to reject anymore. And I think that was one of the big fears in the Dubai market. And running back to a topic we've had over the last couple of weeks, why is Dubai so strong? And one of the explanations was going to be that there's all this sort of pent up forward demand from India potentially, but that at the moment looks like it's not going to happen. On the other hand, it's all wrapped up in Ukraine talks, and yesterday the Americans were, back to the headlines. The most sort of, impactful one was probably Peter Navarro, who started to call it Modi's war. And he also had the most ironic statement of the day, which I have to read out, which is, India, you're the biggest democracy in the world, okay, act like one, which I find quite funny. But, I guess the long and short of it is this story's not over yet. So still need a couple of days to find out what the US response is. And in the meantime, in terms of geopolitics, Ukraine just keeps on firing rockets at Russian oil infrastructure because it's all wrapped up in Ukraine, of course.
Yeah.
And I think there was another one at the weekend, Ust-Luga port, which probably is impacting exports of crude and products. I think I'm not quite sure how much yet. And last night, another refinery attack on Afipski. Never really know. Yeah. So, the Russians are going to ramp up crude exports next month because of it, but it's bullish products. So there's a lot to keep up on. And I guess the long and the short is the story's not quite over, but it might be a point for Dubai to start to weaken all else equal.
Okay. All right. One to keep an eye on. I'm sure we're going to be continually talking about this over the next couple of weeks as well.
The next one's the Fed. So I don't know why, you can feel free to jump in here, but the week has definitely been, in terms of the wider market, focusing on the Fed's response, right? So it's likely we'll get a rate cut in September. The arguments are surrounding how quick it's going to be beyond September in terms of cuts, but it's probably something that's supportive of markets, right? And probably supportive of oil price itself. So flat price, I'm noting, has come up a bit, and this is probably one of the drivers. Is that fair to say?
Yeah, seems so to me.
Well, but I mean,
Thanks.
it's funny because it's in the grand scheme of thing, if you're also cutting rates, usually like lower interest rates, you also have that sort of effect on currency as well. So that usually kind of correlates to a depreciation of the US dollar, which is also inflationary. And so your tariffs that you're doing in America. So it's a lot of things going on, obviously.
Yeah, I was listening to a podcast over the weekend from basically the Yale Budget Lab, which is an interesting sort of think tank. And they rightly pointed out that the word stagflation is doing the rounds a lot more at the moment.
Yeah.
So that's something that keeps the market, let's say, awake at night and related to, it sort of limits what the Fed options actually are from here. And one thing I wanted to pick up on is also, it's not necessarily related to this, but in terms of flat price, the positioning is really quite funny at the moment. So there's actually quite an extreme managed money net length in the ICE contract, so ICE Brent and ICE gas oil just now, and it's very weak in NYMEX TI and NYMEX heating oil, and don't quite understand why that's the case. It's something we can pick up on later, but I'm just noting that actually oil is feeling quite long related to maybe this and geopolitics, at least in ICE, but not in NYMEX.
Okay. All right. One we can pick apart kind of maybe soon after this. I think we had a Geordie data release as well. So how did that fare?
I'll do it really fast. So basically, for me, it's status quo, right? So we've been talking for the past 6 to 9 months about how stocks are tight. I don't see a change. I see gas oil stocks tight in Europe. I don't see a collapse in demand in gas oil. Demand for the other products is quite strong. Even crude stocks are quite tight in Europe. So this status quo, and of course that's for June, so the thing can change, and probably a lot of people are talking about high frequency builds over July and August, but at the moment it's status quo. And the one thing I also wanted to point out is in the weekly data, the US data, where we got a reading last night. My favorite chart, and once we switch to video, we can highlight this to clients. My favorite chart at the moment is the build pace, the stock change of US total commercial oil, so crude and products. And that was unusually bearish over the, let's say, August or July, August, but it's actually rapidly coming again. So it's more tight, closer to last year or the last 2 years. So whatever signal that was is actually now gone. So my sort of my doubts about the US data, let's say, have started to ease a little bit, and it's partly on exports as well, crude exports particularly.
Okay, all right. We can pick kind of TI up as well whilst we get into the crude bit, but I'm going to give you a bit of a breather now to get some water. And good to hear that you listen to some eclectic kind of podcasts on your weekend break, just as a prep getting into this as well. So a nice plug for them there.
One day it's starting to get more important now, right? Because the data is very lagged, and now the question is, we see that the labour market's weakening. A lot of people there's more commentary on it, and it's going to be more important for the oil price going forward.
Okay, brilliant. Okay, so over to fuel oil next. We'll start at the bottom of the barrel. So specifically Dangote, I'd like to pick up on. So that's a story that's got many turns seemingly. So the refinery has a reasonably poor track record by now, right? So what's the story this week that you've got kind of from that?
Well, to be honest, it's kind of all over the place. There was this turnaround for the RFCC that was, it was there, and then people said, okay, it's going to get extended to early Sep, and then we got the news early this week that, apparently they have already resumed, the activity over there on the 22nd, and you're kind of like, okay, so which one do you believe in? I think I talked about this before, but I tend to watch the kind of specs that they send out in the tenders and, what kind of cargoes they're sending out, but the specs are also kind of a bit all over the place, and so it's right now it's really hard to tell from the tender what's really going on there. But I would say my gut feel is that there's probably still some issues to be worked out with the RFCC. I don't think that things are running perfectly fine there at the moment, but on the other hand, the Dangote materials are workable again into Singapore and Fujairah 0.5 blending. We could see in the platform that it's starting to be in the money again, with the after the dips have already weakened, and then you've got like higher premiums in Fujairah, etc., and also kind of softer freight over the last week or two. So
Okay.
yeah.
I don't. This isn't going to be the last time that we talk about Dangote kind of this year, that's for sure. So one to keep an eye on. Yeah, you can keep us updated on the tender specs as well whilst you're there. Okay, so on a related note then, what's up with the Sudan UAE story and why is that important for us this week?
No, that was an interesting story that we saw last Friday. So there were a bunch of like rumors that started floating around Fujairah for a bit. So what happened is that like Sudan, they cut diplomatic ties with the UAE, and the UAE sort of responded by banning the Sudanese cargoes from discharging into Fujairah. And obviously, like you've got like the Dar and now plans, so two of the kind of rather important feedstocks for the topping units in Fujairah, like the one that Vito has, for example. So, that was part of the reason why Fujairah kind of export premium started shooting off last Friday. I'm not 100% sure what's going to happen. I think most likely that would probably get diverted to Tanjong, which is the other, like topping unit that Vito has. It does leave a sort of a gap in the local Fujairah production. I don't have the latest figure off the top of my head. I think it's probably like 300 KT per month in terms of kind of like the local production impact. But you do have a bunch of alternatives, some probably better than the others. I mean, you've got like Doba, you have Yumbo, Malek, even like Escalante, the sizes maybe a little bit different. And they are more expensive to land into Fujairah than Dar now, given that Dar now is a very short journey, I think. So if you take the other grades, it's probably going to be like $1 to like maybe $3. I say $1 to $3 per barrel more expensive to land the other grades than Dar now. But yeah, and on the other hand, you also have summer burn season sort of, ending from this week onwards going into September. So you also going to have more kind of like outshore molecules coming to Fujairah as well. So that's definitely interesting.
Okay. So
I think we haven't seen that price movement yet on the crude side. I mean, the crudes that you highlighted, if it was that dire, we should have seen the price spike, but we haven't. So they might be having some other hidden alternatives or happy with not running for a short while instead of bringing up the spot market.
Fair enough. So no changes on the cash diffs for the crudes.
Exactly. I mean, as I said, there are alternatives around, and it's not like, like they just don't get that materials anymore, the molecules anymore. They just kind of like have to divert it to another place. Well, but it's within kind of like the same region, Singapore, Fujairah.
Okay. All right. We'll keep an eye on the cash diffs for the crudes over the next week or so then and see where we get to with that. I put it in kind of the intro to the podcast that we were going to talk about 0.5 fuel. So just wrapping up kind of where we are on this, what's your outlook for 0.5%?
We have been pretty bearish 0.5 the last few weeks, which turned out to be, right. Thank God. But this week, I guess we're getting a little bit less bearish than last week with all the latest developments that, we just talked about. But overall, I'll be honest with you, I still don't feel that bullish with the S&D that we have. The recent jump in Fujairah premiums, obviously, that did make the big streams very workable into blending in Fujairah right now, and also kind of like in Singapore with the jump. So FOB dips have adjusted down enough across the board that blend margins now look pretty decent again in Fujairah and Singapore. As I said, there will probably be some diversion of the Sudanese stuff, from Fujairah to Singapore, but at the end of the day, that's more of a reshuffling of the flows than than the flow itself stopping, right? So, and the thing that we talked about a couple of weeks ago about the Chinese Q4 quota play, that is not materializing yet this year. Whether that's going to be the case in Q4, I'm not sure. But and as we said before, summer burn is ending, so you've got more of the Q80 molecules coming to supply Fujairah as well. But one saving factor we do have is that the arbitrage, the 0.5 arbitrage from the West still looks very unworkable. Obviously, you always have it's kind of like base volume that's going to come no matter where the arbs are. But, at least that's going to stop some of the more opportunistic flow from coming to the East. So long story short, I'm sort of neutral. I'm not really, I'm less bearish, but I'm not too bullish. 0.5 given the S&D.
That's a good fence to sit on. What I'm going to do is I'm going to go kind of around the rest of the barrel, and Hua, I'm going to come back to you at the end and see if you've got a conviction in anything else that you'd like to share with everyone. So you can take 10 minutes out for that one. Okay, let's move on to crude. Neil, moving back to you. So the crude markets have a lot to contend with right now. It seems that there's a fair amount of uncertainty on a few aspects. So what can you tell us? Why don't we start with your absolute favourite and the North Sea?
Talking about sitting on the fence, like we'll just be doing that for the next 10 minutes, I think. Okay, so what's happened? Let's just talk about signals. So two key ones are the North Sea, the DFL, for example. So the DFL weakened yesterday to essentially a 3-month low on a kind of rolling basis. So relatively cheap, I would say. And we saw the same happening in some of the North Sea FOB prices earlier this week, at least.
Yeah.
And we've been talking about the Brent versus Dubai spread for quite a long time, with Dubai very expensive and, sort of negative Brent Dubai swap levels, or very negative ones. And the thing is that the signal just keeps on getting stronger, if you like. So yesterday we were noting the landed value of 40s into the Far East, for example, has never been this cheap in the history of our tool, which is, it's more than a year. It's not, a 10-year history, of course, but it's particularly cheap, 40s and Brent. And, the question we're asking ourselves is, well, how long can this last? Because from the ARB perspective, there's so much west of Suez crude that is currently arbable into the east. So why has Dubai been able to maintain its strength when you have everything open east? That's basically the question. And where's the breaking point? And maybe that what we were saying yesterday is that, we know that 40s lands at a big discount to Murban only 5% of the time in our history. Maybe that's a key signal. So, that's the first thing. And of course, there's loads of other stuff open. TI looks very cheap into Asia still. Even things like certain WAF crudes look very cheap, which isn't always the case. So that becomes the question. Like, if there's ever a time to kind of fundamentally, let's say, short Dubai relative to Brent, it seems like it would be now. But then, June, I think you're going to take this forward. It's all dependent on Dubai market, seemingly, because it's just not really trading the way that we think it ought to. Is that a fair thing to say?
Yeah, we had a fairly high conviction trade last week to short Dubai, but it's still the main conundrum being faced now. There seems to be like a good or clean reshuffle between India, Russia, China, Saudi crude, rather than creating a massive spike on the spot Dubai alone. And we also heard reports that China has been clearing up the Urals market recently. So maybe one interesting explanation could be that Middle East Gulf exports might not be max, as we have said quite a lot. And we still have that view that they will not export beyond a certain tranche in order to not to spook the markets. But there's obviously some trading dynamics at play, maybe a bull play, and one trigger might be more uncertainty that the Indians are not budging.
Okay. I think that's fair. I mean, we're coming up to APEC as well, so this is going to be kind of an interesting one to see how this plays out in the next 2 weeks for sure. We can pick that up next week. I'm keen to kind of press on because, Neil, you mentioned TI is pricing really well into Asia as well. So I think our call for TI Brent to -$4 was a good one recently that you guys picked out. So, but where do we go from here?
Yeah, I mean, I'm still thinking about, talking about sitting on the fence, I'm still thinking about what to do now, particularly with what we've been discussing the last 5 minutes, the North Sea looking particularly cheap, for example, abroad. Yeah. So lots of people have been asking, why is TI generally so cheap? And I think one explanation is that there's structurally lower demand for it, particularly out of Asia, which will continue despite, some deals being made with Pakistan and Vietnam, which are all relatively smaller players, let's say. And there's also the fact that US supply seems to have been unharmed so far by price. So there's just plenty of supply. So where do we go from here? I think there might be a small bull case for TI Brent spreads, like it doesn't need to get any wider, let's say, because the one thing just now is that North Sea looks too cheap. I would have to call that it gets cleaned out in a certain way, by Unipec or China or, whatever. And the other thing is that US stocks are not that high yet. So, linking back to what we said at the start, there isn't a glut in US stocks. I'm noting that US exports have ramped up quite a bit over the last couple of weeks, and actually on the net import side, or net exports are also up. The only, let's say, spanner in the works is the fact that TI actually looks quite expensive just now into Northwest Europe, but that's largely a North Sea weakness story, and I think that can turn around relatively quickly, let's say. So let's say I don't think TI Brent needs to get any wider on the paper side. One of the things it can still do is on the MEH side, which I think John was talking about last week. MEH might be the first thing to kind of adjust to try and help Afras become a bit more cheaper in Europe. But yeah, it sort of feels like some of the marginal indicators like US exports, like US stocks, it doesn't feel like the glut is emerging yet on TI.
All right. I'm going to give you 5 minutes out as well so that we can come back to you kind of at the end and think about kind of what our convicted crude trades would be. But look, sticking on crude really quickly, June, it would be great to get your take on this. There was a bit of talk this week about Platts Murban methodology adjustments. So just for our listeners out there, what is going on there?
Well, Platts announced that the Murban assessment will change from 2nd of January 2026. The grade could be assessed above, at parity with, or below Dubai, and any other of the medium sour grades in the basket based on bids, offers, and trades observed for Murban partials, cargoes, and related markets. They will rename the existing Murban quality premium to Murban quality adjustment. And the purpose is to allow the value of the Dubai benchmark to more dynamically react to shifts in sweet and sour fundamentals. Neil, you got anything to add on for this comment?
No, I mean, it's one thing that maybe is not being worked out yet is the fact that the adjustment will be basically 100% of the differential to a man when it's pricing below a man, and it will be a smaller adjustment if it's pricing above a man. So there's like, how do you call it, distortion depending on whether Murban is cheaper or more expensive. I'm not quite sure that the market has figured that out, whether that is fair or not. Maybe we need to think about it a bit more ourselves as well. But it seems like something that maybe the market might not be too happy with, let's say.
Yeah, I did hear someone say that the crude traders are not, will find this a bit harder to trade. That was a comment that I received.
Okay, one to watch from that one. And well, as I said, we're going to be in APEC as of next week as well. So we'll probably get kind of a lot of feedback back from the numerous events that we've got going on. Okay, thanks for the crude side. So let's move on to some more of the clean products and do our final segment of today. So let's kick off with distillate. James is still out. So Neil, do you want to run us through quickly kind of what the big changes are this week? I think you've been writing this week in the commentaries and the snippets about East West in particular.
Yeah, that seems the obvious one to me. So generally speaking, I was listening to you guys last week. I generally agree. It seems like there's a mild bull case emerging for Europe for the next couple of weeks because ARBs have been closed.
Yeah.
The main thing now is that the East-West has been extremely wide, and what Singapore is doing or what Asia is doing is pricing to get rid of as much volume as possible. So also the usual players, let's say we always talk about the swing barrels between SICA or the decision for West Coast India between Singapore and Europe. For a long time, the last few months, it's typically been heading east, and now it's heading west, but very, very clearly west, and that hasn't really been the case for quite a long time. So there is something's changed about the Asian balance seemingly that is needing to making it priced this way. So that's something for the medium term. Let's say something seems to have changed in Asia, but in the very short term, the East-West looks very, very wide, and I can't think of a weakness in the kind of bull case for Asia over Europe just now, because you've got the swing bars heading west. You've even got some unusual signals. You've got Singapore pricing into East Coast Latin America. I'm not even sure that's a big flow, but it's definitely another signal that kind of tells you that Asia might be too weak. So that's the relatively higher conviction call, I suppose, on the East-West for the short term. And I had to rewrite a bunch of stuff 5 minutes before the pod because we noticed this morning that I was going to say that the Gulf Coast ARBs to Europe are closed, and that feeds into the bull case, but they're not actually this morning. So the LR ARBs from Gulf Coast and from St. John are open to Europe now. The MRs are not, and that's partly because of the extra freight cost. The TC14 is extremely expensive still. We do think that will come off, which may well open up the MR ARB as well. Typically, we see that the LR ARB does not stay open for long, and nor does the MR. Basically, they tend to correct. The question is, how is it going to correct? I'm not quite sure I know yet, but it seems to me like the HOGO might be a bit of a buy. So the one thing is that Europe might have to price down because all the arbs are open now, basically, except the MR from the Gulf. And the other thing is that, Pad 1 stocks, they're not that high ahead of winter. And there's the thing that always pops up again. It's the Russia flow, right? So all these attacks on Russian refining infrastructure are presumably going to see substantial reductions in Russian diesel exports, and that increases the draw from LATAM on Gulf Coast volumes. And that together just makes me think, well, probably the HOGO is a buy. Even though the HOGO is still relatively wide just now, it's come off a fair bit, but I think possibly it's a buy just now.
Okay, good that we've got the tool to kind of update that first thing this morning, which is good. So that's some great insight. Anything else on distillate that we need to kind of pick out before I hop onto a quick fire round?
No, the only thing I would do, just two things to add to that is again the positioning. So I'm not quite sure why NYMEX heating oil positioning is so weak, but ice gas oil so strong, and that possibly heads into the same direction as I've just said in terms of where the HOGO might go, because there's dry powder and for length in heating oil. And the other thing is, it does seem from a fundamental perspective, one of my other favorite charts that I cook up is my little gas heat indicator in Pad 1, which is, again, if we start to get video, we can show clients. But basically it compares the glut versus seasonality in Pad 1 for gasoline versus diesel. And that basically come in a lot over the last 6 weeks. So there was a glut in gasoline relative to diesel, and now it's basically reversing. And that might tell you something about the need to switch yields. I'm noting that the US gasoline yields are coming up a lot over the last week or two as well, which, all else equal, also helps the heating oil complex eventually.
Yeah, okay. And thank you very much for the spoiler as well. We will be kind of switching to video so people can see kind of our smiling faces throughout this podcast in the next couple of weeks. Just waiting for kind of the usual ring lights and cameras to kind of show. So, and also kind of makeup artists as well while we're at it.
I've got to iron a shirt.
I know. So no more pajamas. So look, not negating kind of the rest of the barrel, why don't we just do a quick fire round? I think, June, you might want to kick us off on this one. So what's interesting kind of on the rest of the complex?
We'll start off with naphtha. Asia market has been supported and it's helping to narrow the gas gap. Europe is also surging, and naphtha is particularly supported in October because we are having peak refinery turnarounds here, and so naphtha supply gets reduced. Petchems will run hard before their peak turnaround season for the steam crackers in November. And then we got recently the Long Song cracker starting up, which is in Vietnam. This is supposed to have started up last week. And we've also heard about the Ust-Luga drone attacks. So we are expecting reduced naphtha exports from there. Let's have Jorge back next week to share more about the developments of naphtha market.
Brilliant.
For gasoline side, lifting ARA blend costs and helping to shut the RBOB up again. ARA refineries are out of the money. This comes though as Dangote has returned and reversed the EBOB rally in August. But let's watch out for Pad 1 and Pad 2 gasoline stocks, which are starting to look tight again.
Yeah, and Dangote as well. Yeah.
Yeah, indeed.
I was literally going to say, you literally have to watch it day by day, and you're like, okay, maybe it's going to be different tomorrow.
Yeah, indeed. And a little bit on dirty freight. So for TD25, EFRA supply is 3 below average and materially tighter than last week. WCI into Northwest Europe is competitive now. TD25 RBI, which is the relative basket index from Sparta, it continues to be undervalued and is by far the cheapest vessel class into Northwest Europe, and well below the average tonnage, implying spot and September will soon price north of 160 world scale. Oct and North RBIs are now materially overvalued and limiting upside beyond September for now. Finally,
so short-term play, and I think kind of Neil wants to pitch in on this one.
Oh, sure.
Yeah, that goes against the TI Brent call. Just it's good to have that, but that again proves that I probably haven't thought. I mean, I'm low conviction on that, let's say, but we'll see.
Okay. Good one to watch. Do you want to carry on dirty freight?
Yeah, just the last one on TD3C. So the RBIs have moved more undervalued. That's a bullish TD3 signal and implies more strength to come. VLCC supply is still well below the average, but higher than the 24 open vessels that we saw middle of last week. Arab Light is actually fairly valued into China. So Q4 still looks like a buy, even after the recent strength.
Okay. Brilliant. Right. Why don't we do just a quick fire round, just in terms of if you had to pick one thing kind of this week going into APEC, what are the questions that we might have to start asking people about, or what are the convincing trades that you have? I appreciate there's a lot of uncertainty this week, shall we say. So Hua, starting with you on fuel.
I'm still on the fence, Rachel. I mean, I'm definitely less bearish 6.5 this week than the previous 2-3 weeks. I mean, kind of neutral, not really bullish, honestly. But as I said before, September arrivals into the east 4.5 kind of, I mean, they look a bit lower for now. But yeah, still don't really feel bullish about, that given the S&D that we're seeing until we see a bit more signs of stuff happening. High sulfur also doesn't look too exciting in the moment. Burn season is ending. I don't think we are really seeing signs of the Chinese teapot picking up too much of the stuff yet. I mean, they did talk about it going into Q4, so that could definitely happen. And, and when the Chinese buy, they really do buy. And obviously, that would have massive impact on the entire market. So I guess I'm still on the fence, but I'm still leaning a little bit more on the bearish side for both low and high.
Okay.
I would say.
All right. We'll keep track of that. And I'm going to have you on Dangote watch, shall we say, for the next week or so as well. June, any high conviction kind of trades, or is there anything in particular that you'd like us to kind of think about going into APEC maybe?
I think naphtha is really interesting. We made a call last week that AUK Gas NAP and AUK Sing 92 MOPJ should narrow based on the fundamentals that I shared. And we already saw that happening early this week. MOPJ spread and cracks are really strong as well. So I'm still thinking there's legs to go on these two spreads. So that's my high conviction call.
Brilliant.
Actually, there is a very interesting, I mean, we're running out of time, but there is a very interesting relationship between naphtha and kind of like the straight run fuel oil in the East. I think we did talk about this before where, like in the past, we did have those times when some of the bigger teapot in China realized that, it's a bit too expensive to get naphtha. So what they did was that they would get a ton more of the straight run stuff, which, they do have the unit that specialize in cracking the straight run into stuff that's, like naphtha range
value,
sort of molecules. Exactly, which, they use for the petchem stuff. And then so that there is an interesting relationship there.
Well, you need to come up with a chart for that, please. In the next for APEC. There you go.
That's a good idea.
Yeah, we can chat about that in the breakfast briefing that we have. Okay, well, June's got a high conviction trade. While you are somewhat neutral across the board on Dangote watch. Neil, how are you feeling after kind of the TD25 move as well that June kind of put out?
Yeah, I think maybe in order of confidence, I would say, because I covered quite a lot, I'd say the North Sea DFL looks like it needs to rebound. Then I would say the gas oil east-west seems like it ought to narrow. And then the lesser ones would be the Hogo, I think, is a buy, and TI Brent, I'm not actually sure, but it's probably a rubbish call right now. I need to think more.
That's fair enough. I mean, you have been out of the office, so I will give you some grace on that one, and we'll see what we come back to on this one next week. That's for sure. Okay, well, next week will be our podcast before we head into APEC, so we'll start touching upon what are the big themes that we've got coming up, especially in our breakfast briefing during the APEC week. And if you would like to join us for that, please do. You can find kind of links in our events on our website. But for now, I think that's a wrap for us this week on Sparta Market Outlook. So we have covered everything from reef shuffles in the east to disappearing North Sea bids, creeping stagflation fears, and whether fuel oil is finally getting interesting again, albeit while it's still neutral. So if you've made it this far, congratulations. Your badge for Podcast Listener of the Week is absolutely in the post. As always, if you've got feedback, trade ideas, or a burning desire to fact check Neil's hot takes post-holiday, you know where to find us. Bonus points if your messages include a chart, obviously, some sarcasm, or both. So look, we'll be back next week with James rejoining the crew, fresh from paternity leave, presumably sleep deprived, but ready to drop some heavy takes between bottle feeds. And let's see if he's still perma-bullish in the distillate market. So until then, keep your wrist tight, your cracks profitable, and your inbox alert for the next episode. Thanks for listening.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.